Hi everyone! Since the start of the year, the stock market has been very volatile. The sell-off has been most severe for tech and growth companies, with the Nasdaq falling into correction territory early this week. The sell-off can be attributed to various reasons. First, inflation. Late last year, the Federal Reserve signaled that it will soon raise interest rates to fight inflation. Speculation around the timeline for rate hikes pushed the 10-year US Treasury yields to as high as 1.9% last week. Higher interest rates typically put downward pressure on stocks, especially tech and growth companies that are more sensitive to rate changes. Another catalyst for the Nasdaq's correction was Netflix's disappointing earnings, which resulted in a 20% slide in the share price. We expect the stock market to remain volatile in the coming weeks as investors digest the Fed's latest remarks. After the recently concluded FOMC meeting, there were indications that we would have liftoff as soon as March. The market is now pricing in 4 rate hikes this year. After rebounding earlier in the day, major US indices turned negative, and Chair Powell mentioned that there's quite a lot of room to increase rates. Although choppy markets can be hard to bear, it is important to note that pullbacks are a normal part of resetting stock valuations and investor expectations. The Nasdaq has seen the correction happen about 1.3 times each year on average. For the S&P, a drop of 10 to 20% happens about once every 2.5 years. For long-term investors, the key takeaway is that while declines in the market happen from time to time, these declines occur far less frequently as compared to advances. Additionally, market advances are not only more frequent, but also outsized. In summary, investors should maintain a long-term perspective and stay invested. Missing just 10 of the stock market's best days can cut your overall return by more than 50%. The market's best days typically occur within 2 weeks of the worst days. When you exit the market, you not only realize your losses, but risk missing out on the recovery that follows. Remember, the bad days are few, there are more good days, and the good days can be excellent.